There's a legal mechanism in modern banking that has wiped out savings and livelihoods again and again for over a century. A bank officer approves a loan for $10,000. She types numbers into a computer, and $10,000 appears in the borrower's account. Money that didn't exist seconds ago. This isn't metaphor. In 2014, the Bank of England published a paper stating explicitly, whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. New money, created by typing. And when this mechanism scales up, it doesn't just fuel growth. It builds booms, triggers crashes, and the bill comes back to the public through inflation, unemployment, and bailouts. This is the story of how the trick works, what happens when the trick breaks, and why the cost always lands on you. Let me show you the magic and why you're the one paying for it. Act 1. The trick. Here's the rule. Bank money is real until confidence breaks. Most people think banks are warehouses for money. You deposit $1,000, the bank stores it in a vault, and when someone needs a loan, the bank lends out your $1,000. That's not how it works, not even close. Here's what actually happens. And once you see this, everything else makes sense. When a bank makes a loan, it creates two entries in its ledger. On one side, an asset, loan owed to the bank, $10,000. On the other side, a liability, deposit in borrower's account, $10,000. The deposit is spendable money. It didn't come from anywhere. It was created by the accounting entry. The bank didn't take money from depositors. It didn't borrow from the Federal Reserve. It typed numbers and created a deposit. That's the trick. A legal, everyday accounting maneuver that conjures money into existence. And that deposit, that new money, enters the economy. The borrower spends it. It becomes someone else's deposit. And that deposit can be used to create another loan, another deposit, more new money. This is how the vast majority of money enters the economy. Not from government printing presses, from private banks making loans. Look at your bank account right now. That number isn't cash sitting in a vault with your name on it. It's a database entry, a promise that the bank owes you that amount. And that promise was created when someone, somewhere, took out a loan. The power to create money, the power that used to belong exclusively to kings and governments, now belongs to private banks. And here's the twist. They use that power constantly. Every mortgage, every car loan, every business loan. Money created from nothing. But there's a catch. The money only works as long as everyone believes it's real. As long as confidence holds. The moment people doubt the bank can pay, the moment they rush to withdraw, the illusion collapses. Because the bank never had all the money. It created deposits worth far more than it actually holds. And when confidence breaks, the money that appeared from nothing can disappear just as fast. The system starts in the 1600s, London. Goldsmiths. People would deposit gold with goldsmiths for safekeeping. The goldsmith would issue a paper receipt. These receipts were easier to carry than gold, so people started trading them as money. The goldsmith noticed something. Not everyone redeemed their receipts at the same time. Most of the gold just sat in the vault. So the goldsmith got an idea. He could issue more receipts than he had gold. He could lend out receipts for gold that doesn't exist and charge interest. As long as not everyone demanded their gold simultaneously, no one would know. This is the birth of fractional reserve banking. The goldsmith holds a fraction of the gold he owes. The rest is lent out. It's brilliant. It's profitable. And it's catastrophically dangerous. Because if word spreads that the goldsmith issued too many receipts, everyone rushes to get their gold. A bank run. The goldsmith can't pay. He has receipts for 10,000 ounces of gold, but only 1,000 ounces in the vault. The first 1,000 people get their gold. The rest get nothing. Their receipts, their money, worthless. And here's the bill. The people who trusted the system, who held the receipts, they lose everything. Not because they made bad decisions, because the goldsmith created more claims than he could honor. This happened repeatedly. Goldsmiths collapsed. Banks failed. But the system spread because it was too profitable to stop. By the 1800s, fractional reserve banking was the norm across Europe and America. And with it came a pattern. Boom and bust. Easy credit fuels expansion. Speculation, then panic, bank runs, collapse. In 1907, the United States faced a financial panic that nearly destroyed the economy. Banks in New York had lent aggressively. When the speculation failed, depositors panicked. They rushed to withdraw money. Banks didn't have it. The Knickerbocker Trust Company, one of New York's largest, faced a run. Depositors lined up around the block demanding their money. Within hours, the bank was out of cash. It closed. The panic spread. The stock market crashed 50%. The crisis was only stopped because J.P. Morgan personally organized a bailout. He locked the major bankers in his library and forced them to pledge money to stabilize failing banks. The system works until confidence breaks, and confidence always breaks eventually. Because the money exists as a promise until too many people demand it at the same time. Congress responded by creating the Federal Reserve in 1913, a central bank designed to be a lender of last resort, to provide liquidity when banks faced runs. But here's the twist. The Federal Reserve didn't stop money creation. It enabled more of it because now banks knew they had a backstop. They could lend more aggressively because the Fed would save them if things went wrong. The incentive structure changed. Banks got the upside of aggressive lending: fees, interest, growth. The Fed, meaning ultimately taxpayers, took the downside, risk expanded, and things went very wrong. Which brings us to Act 2. Act 2, the trick breaks. The 1920s, credit expansion on a scale never seen before. Banks lent freely, consumers borrowed to buy radios, cars, appliances, businesses borrowed to expand, investors borrowed to buy stocks. You could buy stocks with 10% down and borrow the other 90%. Margin lending. The money to fuel this came from banks creating credit, creating deposits. And it worked. The economy boomed. Stock prices soared. Everyone felt rich. But here's the rule restated. Money created as debt only exists as long as the debt can be repaid. When debt can't be paid, the money disappears. October 1929, the stock market crashed. Prices collapsed 50% in weeks. Investors who'd borrowed to buy stocks couldn't repay their loans. They defaulted. Banks, which had created billions in deposits backed by inflated stock values, were suddenly insolvent. The loans were worthless. The deposits they'd created were backed by nothing. Depositors, seeing banks fail, rushed to withdraw. Bank runs spread across the country. Between 1930 and 1933, over 9,000 banks failed. That's the FDIC's official count. More than 1/3 of all banks in America. Gone. And here's the bill. Depositors lost $1.3 billion in savings. That's about $27 billion in today's money. But the real cost was the money that vanished. The deposits those banks had created, the money in the economy, it disappeared. The money supply contracted by 30%. 1/3 of the money in circulation ceased to exist. Not because it was destroyed, because it had been created as debt. And when the loans failed, the deposits evaporated. Businesses couldn't get loans. Consumers couldn't spend. The economy collapsed. Unemployment hit 25%. 1 in 4 Americans out of work. Families lost homes. Farms foreclosed. People stood in bread lines. Not because of war, not because of natural disaster, because the money that had been created from debt returned to nothing when the debt couldn't be repaid. And millions of ordinary people paid the cost. Your great-grandparents, if they lived through this, they learned the hard way that bank money can disappear. The government responded. Franklin Roosevelt created the FDIC in 1933, Federal Deposit Insurance, deposits up to $250,000 guaranteed by the government. The idea was to prevent runs. If people knew their deposits were safe, they wouldn't panic. But notice what this does to incentives. Banks can now take bigger risks because depositors are protected. The banks get the upside of risky lending. The government, meaning taxpayers, takes the downside of losses. The moral hazard is built in. But at least there was still one break on the system. The dollar was backed by gold. Under Bretton Woods, established after World War II, foreign governments could redeem dollars for gold at $35 per ounce. This limited money creation. If the U.S. created too many dollars, foreign countries would demand gold and U.S. reserves would drain. It was a check, a constraint. Until August 15th, 1971. President Nixon closed the gold window. The United States would no longer convert dollars to gold. Bretton Woods was dead. The dollar became pure fiat currency, backed by nothing but government promises. Why? Because the U.S. had been creating too much money, spending on Vietnam, spending on programs. Foreign governments noticed. France demanded gold. Germany demanded gold. U.S. reserves were draining. Nixon had a choice. Stop spending or cut the link to gold. He chose to cut the link. And here's the consequence: inflation. The 1970s saw inflation average over 7% per year. It peaked at 13.5% in 1980. Prices doubled in a decade. Your savings didn't get stolen in a robbery, they got diluted. Every new dollar created made your existing dollars worth less. This is the hidden bill. Inflation is a tax, not voted on, not transparent, but extracted from everyone who holds the currency, and it's the direct result of removing constraints on money creation. Let's fast forward. The system now has no gold constraint. Banks have FDIC backing. The Fed provides liquidity, and they take bigger risks. The 1980s brought deregulation. Banks merged, grew larger, expanded into new areas. The savings and loan crisis hit. Over 1,000 banks failed. Taxpayers paid $124 billion in bailouts. That's the bill again. But that was a preview. The real catastrophe was building in the 2000s, and this is where the pattern reveals itself most clearly, where you see exactly how the trick scales up and why the public always pays. Banks in the 2000s, armed with the ability to create deposits through lending, went on the biggest mortgage binge in history. Home prices were rising. Banks would create deposits, make loans to anyone, and sell the mortgages to investors, pass the risk down the chain. Subprime mortgages, loans to people with bad credit, no income verification. Ninja loans, no income, no assets. Just sign. The bank creates the deposit, the borrower gets the money, the bank sells the loan. Everyone profits, as long as home prices keep rising. Here's the twist most people miss. The money created for these mortgages didn't stay in housing. It spilled into the economy. Homeowners borrowed against rising home values, home equity loans. They spent on cars, vacations, renovations. GDP grew, unemployment fell. It looked like prosperity. It was a bubble. Built on money created from debt, backed by assets whose prices were inflated by the loans used to buy them. A circular illusion. Home prices stopped rising. They started falling. Borrowers who couldn't afford mortgages couldn't refinance. They defaulted. The money the banks had created, the deposits in the system, started evaporating. Banks had lent trillions. When borrowers defaulted, the loans turned to losses. And because the banks had created far more deposits than they held in reserves, they didn't have the money to cover losses. Bear Stearns collapsed in March 2008. The Fed orchestrated a rescue. September 2008. Lehman Brothers, one of the largest banks in the world, filed for bankruptcy. $600 billion in assets gone. The panic was global. Credit markets froze. Banks stopped lending to each other. No one knew who was insolvent. The money that had been created so easily was disappearing. And when money disappears, economies collapse. Stock markets crashed 50%. Housing prices fell 30%. Unemployment spiked to 10%. And here's the human cost. Over 8 million Americans lost their homes to foreclosure. That's families packing belongings into cars, leaving houses they thought they owned. Entire neighborhoods became ghost towns. Rows of foreclosed homes, empty, deteriorating. Your neighbors, gone. Retirement accounts were cut in half. People who'd worked 40 years, saved diligently, saw their 401ks collapse 50%. $1 million became $500,000 overnight. Not stolen, not gambled away. Erased because the underlying assets, the loans, the deposits, they were built on debt. And here's the pattern reveal. The system doesn't collapse because banks are incompetent. It collapses because the money is literally created as debt. When debt can't be paid, the money disappears. The trick breaks the same way it starts, with ledger entries. But here's the part that crystallizes the entire mechanism. The banks that created this, that created trillions in deposits and lent recklessly, they were saved. The U.S. government bailed them out. $700 billion authorized. The Federal Reserve's actions were far larger. Emergency lending programs, asset purchases, liquidity support. Estimates range from $7 trillion to $29 trillion in total support. Bloomberg News analyzed Fed data and found $777 trillion in committed support to banks. That's documented. And who's on the hook? The American public. Not because they caused it, because the banks were too big to fail. If the banks collapsed, the entire system would collapse. So the government stepped in, socialized the losses. Here's the bill itemized. The public pays 3 times. During the boom, higher asset prices. Homes became unaffordable. Stocks inflated. If you didn't own assets, you got priced out. During the bust, jobs and homes. 8 million foreclosures. 10% unemployment. Savings cut in half. After the bust, inflation and debt. The bailouts, the money printing. It all comes back as higher prices and government debt you'll service with taxes. Act 3. The trick gets bigger. After 2008, the solution was to create even more money. The Federal Reserve dropped interest rates to 0 and launched quantitative easing. The Fed created new money and used it to buy bonds from banks. From 2008 to 2014, the Fed created $3.5 trillion. New money typed into existence. This was supposed to stimulate the economy. It inflated asset prices. The stock market recovered. Housing stabilized. But who benefited? Asset owners, people who owned stocks. Real estate, your rent didn't rise because your apartment got better. It rose because credit got cheaper and investors could borrow to buy properties. If you owned assets, you got richer. If you didn't, you got left behind. The wealth gap widened and the money supply exploded. Now here's that number. The U.S. money supply, M2, has increased 400% since the year 2000. Federal Reserve data, publicly available. That's not economic growth, that's money creation. All that new money didn't create proportional new production. It created inflation in assets and made everything more expensive for ordinary people trying to buy their first home. Then 2020, COVID-19, lockdowns. Unemployment spiked to 15%. And the response was money creation on a scale that made 2008 look restrained. Congress passed stimulus bills totaling $5 trillion. This Federal Reserve cut rates to zero again and launched QE on steroids. In 2020 alone, the Fed created $3 trillion. And here's the critical moment. March 2020. The Federal Reserve reduced the reserve requirement for banks to 0%. This is documented on the Fed's website. One of the major breaks was removed. Banks were no longer required to hold any reserves against deposits. The remaining limits became capital requirements, risk calculations, and confidence. And confidence is the one that snaps. And the money supply exploded. The U.S. M2 money supply grew 27% in 1 year. The chart goes nearly vertical in 2020, the largest increase in recorded history. Trillions created and injected. Stimulus checks, expanded unemployment, PPP loans, much of it necessary to prevent collapse. But it was all new money, and that money had to go somewhere. It went everywhere. People spent stimulus checks, businesses took PPP loans, investors, flush with cash, bought stocks. Stock markets hit records in the middle of a pandemic. Housing prices surged 20% in a year. Everything inflated. And here's the bill. By 2021, prices started rising. Inflation hit 7%. 2022, 9.1%. The highest in 40 years. Bureau of Labor Statistics data, undeniable. Gasoline doubled. Grocery bills increased 15%. Rent soared 30% in some cities. Supply shocks mattered, yes, but money growth amplified it massively. You don't get 9% inflation without massive money creation. Your savings didn't get stolen. They got diluted. If you had $50,000 in savings, it could buy $45,500 worth of goods a year later. You lost $4,500 in purchasing power without spending a dollar. That's the hidden tax. The consequence of trillions created in 2020 and 2021, and everyone who holds dollars paid it. The Fed tried to fix it by raising interest rates from 0 to 5.5% in 18 months, the fastest hikes in history. And this created a new problem for banks. Banks that had created deposits and invested in bonds paying 2% were now stuck. When rates rise, old bonds lose value. If you're holding a bond paying 2% and new bonds pay 5%, your bond is worth less. March 2023, Silicon Valley Bank collapsed. SVB had $120 billion in bonds that had lost 20% of value. A $20 billion paper loss. Depositors panicked. They tried to withdraw $42 billion in a single day. SVB didn't have it. The deposits existed, but the assets backing them were liquid. SVB collapsed in 48 hours. Second largest bank failure in U.S. history. Signature Bank failed days later. First Republic collapsed in May. Bank runs in 2023. The same pattern, the same mechanism. Deposits created, confidence breaks, money disappears. And the government stepped in again. The FDIC, Treasury, and Fed announced unlimited guarantees. All deposits at failed banks protected, even above the $250,000 limit. Taxpayers on the hook again to prevent contagion. It worked. The panic stopped. But here's the rule restated. The trick is the same. The cycle is just faster. 1929 to recovery took a decade. 2008 to recovery took 5 years. 2023 took 5 months. Because the government intervened instantly with guarantees. Same mechanism. Credit creation, confidence break, bailout, but accelerating. And the scale keeps growing. Here's the second pattern reveal. The public pays 3 times every cycle. During the boom, asset prices inflate. Housing becomes unaffordable. If you're trying to buy your first home, you're competing against deposits created by banks for loans. Prices rise faster than wages. You're priced out. During the bust, jobs and homes, foreclosures, unemployment, savings collapse, you lose what you had. After the bust, inflation and debt service. The bailouts come back as higher prices. The government debt gets serviced with your taxes every cycle, 3 times, and it compounds. From 1971, when Nixon ended gold backing, to 2285, the dollar has lost 98% of its purchasing power. Bureau of Labor Statistics inflation calculator shows it. What cost $1 in 1971 costs $7.70 today. Your money is worth 1/13 what it was. Not because of bad luck, because of continuous money creation. Every dollar created dilutes every dollar that exists. It's a slow extraction of purchasing power. But it's not just inflation. It's the boom-bust cycle. The 2008 crisis destroyed $16 trillion in household wealth. Home equity, retirement accounts, gone. Federal Reserve data on household net worth shows the drop. Recovered eventually for those who held on, but millions sold at the bottom. Locked in losses. Never recovered. The 2020 money printing created the inflation of 2021, 2023. Real wages fell, even as nominal wages rose. Workers got raises and still got poor because prices rose faster. And the bailouts. TARP, $700 billion Fed emergency support, trillions. Guarantees for SVB, hundreds of billions, all public money, used to rescue banks that created the crises through their own deposit creation. So here are the 3 ways the system charges you. First, during the boom. Asset prices inflate faster than wages. Your rent goes up. Your first home becomes unaffordable. You're competing against money created by banks, and you're losing. Second, during the bust. Jobs disappear. Homes get foreclosed. Retirement accounts collapse. The money that was created vanishes, and you're left holding the losses. Third, after the bust. Inflation and bailouts. The government prints money to rescue banks. That money comes back as higher prices at the grocery store. And the government debt used for bailouts gets serviced with your taxes for decades. 3 charges. Every cycle. And it compounds. Here's what you need to understand. This will happen again. The system hasn't fundamentally changed. Banks still create deposits when they lend. The Fed still creates money when crises hit. The reserve requirement is still 0. The remaining limits are capital requirements, risk models, and confidence. And confidence is the one that snaps. As long as people believe in the system, it continues. But the amount of money being created keeps accelerating. U.S. national debt is $36 trillion and are growing $2 trillion per year. The Fed's balance sheet is $7 trillion, all money created to buy assets. Each crisis requires more money creation to solve. 1907 required one man organizing bankers. 1933 required deposit insurance. 2008 required $7 trillion in emergency support. 2020 required $10 trillion in removing the reserve requirement. The scale grows, and each time the cost lands on you, through inflation, through bailouts, through the dilution of your savings. The foundation for the next crisis is being built right now. The money supply is at all-time highs. Government debt is at all-time highs. Asset prices are inflated beyond fundamentals. And the system has fewer structural constraints than ever before. 0 reserve requirements. Fed backstops proven reliable. Moral hazard everywhere. The banks have learned they'll be bailed out, so they take bigger risks, create more deposits, fuel bigger bubbles, and when it pops, they'll be rescued. You won't be. The pattern says the next crisis is not a question of if, but when. Maybe it comes through inflation spiraling beyond control. Maybe through a banking crisis that makes 2008 look contained. Maybe through a sovereign debt crisis when global creditors lose faith in dollar-denominated bonds. But it's coming. Because the system is designed to create deposits through debt and collapse when confidence breaks. That's not a bug, that's the design. Money created from debt cannot create real wealth. It can only create the illusion of wealth. And when the illusion breaks, reality is brutal. The trick works until it doesn't. And when it stops working, the bill lands on the public. Every time. 3 times per cycle. Boom, bust, aftermath. If this opened your eyes to the mechanism, if you finally see that your purchasing power is being quietly extracted through a system most people don't understand, then you're starting to see the pattern. But here's the question that leads to the next layer. If money is created as debt, and debt keeps growing, what happens when debt can't grow anymore? When every borrower is maxed out, every government is at the limit, and the system can't create new deposits because no one can take on more debt? That's the endgame scenario, and it's closer than most people think. The math says we're approaching the point where the debt can't expand, and when debt stops growing, deposits stop being created. And when deposit creation stops in a system built on ever-expanding credit, the entire structure inverts. That's the next crisis, not just a banking crisis, a debt saturation crisis. And the consequences will be unlike anything in modern history, because every prior crisis was solved by creating more money. The next crisis arrives when that solution stops working. Banks create money from debt. The system works until confidence breaks. When it breaks, the deposits disappear, and the public pays through inflation, unemployment, and bailouts. That's not theory. That's documented history. Repeating. And the foundation for the next cycle is being built right now. The only question is whether you'll see it coming or be caught holding paper when confidence finally collapses.